From the morning reading, right now the distribution count on both the NASDAQ and the S&P 500 is at 9. This is the highest level in at least 3 years at any time that the current outlook was still uptrend under pressure, not outright correction. Also, according to the American Association of Individual Investors, mom and pop investors have their highest exposure to stocks since 2007 and nearly their lowest cushion of cash since 2000. Option traders and 10-year Treasury note futures have continued to trade call options, but put volume has dried up, pushing the put-call ratio to nearly the lowest level in years, a development that has led to trouble in longer-term Treasury prices. Good morning, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:16 a.m. Central Time, and I'm recording this in preparation for the market day, April the 2nd, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in and see what happened with the overnight. We had weakness, and indeed broad weakness, across all four of the broad market indices. We're down about 1/3% at the time of this cut. Also take a look at crude oil, once again getting hammered last night, down well over 2%. You have the euro up about 0.5%. You have bonds up about 0.34, and gold down about 1/3. So pretty significant action last night in our own markets. In overseas markets, you had China up about 0.4, Hong Kong up about 0.7, Japan very up about 1.46. Germany and United Kingdom were essentially scratch. In terms of macroeconomic reports for today, you have factory orders and nat gas. And then, of course, before the market opens, you have the unemployment claims. Also be aware that you've got, with tomorrow, a market that's closed for the Good Friday holiday. This is a trade holiday, so the futures markets will be open for just briefly, very early in the morning. Really, in essence, the overnight session, and then we'll close early morning. So you'll have the big monthly unemployment report come out against no market open activity. So could be a significant weekend, and between the close this afternoon and the open on or the futures open at least on Sunday night, or the regular cash open on Monday, there's a pretty good opportunity for a significant gap to occur. So just be aware that you have some additional risk in the marketplace. In terms of our volatility, the standard deviation moves continue, albeit at the same time that we don't really seem to go very far, and we still are within the range. And because of this, a lack of fear by the broad institutions, we still have this very low implied IV percentile. Short-term VIX on the S&P 500 is a 14.29, and you see from a volatility standpoint, that is very, very low. From an actual price movement standpoint, we've seen a lot of standard deviation moves, and this count here is about as high as I have seen in a very, very, very long time. I guess out of 10 trading days, we have 6 that have at least a 1 standard deviation move, and a couple of those were well over 2 standard deviations on the S&P. So very, very much a movement going on in the intraday. In terms of our regular daily report, not a lot of changes from yesterday. We still remain with an intermediate term phase opinion Big picture, phase 3, higher highs, higher lows is what we're looking for, but obviously this continues to be under enormous amounts of pressure. IBD status remains uptrend under pressure. GMI index remains a 3 out of 6 with a buy signal. Active trader market posture remains moderately bearish, no changes there. Position sizing opinions also are the same, with portfolio calling for up to 50%, and the active trader based on volatility based on the VIX window being 75 to 100%, but obviously you need to put this in context with all the other information that's coming in here. You do have on the market timing opinion a 1-day and 3-day outlook that is calling for bullish, but a 2-week that is slightly bearish. So this is definitely a lot of crosswinds coming through here. From a market posture standpoint, you got 3 of the 4 broad market indices that are moderately bearish, including the most important one, the S&P, a very, very low rating here, 33.2. And indeed, if it goes to a 20, that will be significantly bearish. And you're, as a result of that, having an opinion of no new short-term or intermediate-term bullish trades. In terms of the hedge warning status, we remain at an elevated level of level 2, and this comes from a number of places. Volatility metrics, we have these first 2 that have been flipping back and forth, firing and then coming off. They did come off yesterday, but you know, these have been basically alternating back and forth. You do have a VIX squeeze present on the daily candle, so be aware of that. Now, often when that squeeze fires, it's going to fire with the market going short, not long. So, you know, especially when you consider that volatility is already relatively compressed from a VIX perspective, this is not likely to fire going from, you know, a 14 or 15 down to 10. It's likely to either continue in a long-term consolidation, then eventually fire long, which means the market would go down. So this VIX squeeze is just another warning. And I mentioned at the top of the broadcast, look at the distribution day count here. S&P 9, NASDAQ 9. We normally start getting kind of antsy when we see this thing at 4 to 5, and especially from 5 to 6, and now we're at 9. This is a very high count to still have our IBD status remain no worse than uptrend under pressure. Most of the time when you have a count this high, you're in market and correction status outright. So that should be a significant warning to you. In terms of the E-mini charts, the only thing that's showing there of significance is that crash warning that came a few days ago, and then you also have all 5 of the key intermarket risk aversion indicators showing as risk-off conditions. Our opinions on terms of option income strategies, though we recognize that the VIX is inside the acceptable window, but given that we have so many standard deviation moves occurring, the traditional option income strategies are probably left in park mode unless you are very, very nimble and very good at adjusting and or are able to leverage an opportunity for increased volatility. Covered calls would not initiate any new positions at this point, but certainly as you start to prepare your watch list, you start thinking about an equal distribution between in the money and out of the money. Put selling, we normally think of weakness and spikes as opportunities to sell puts against core portfolio baskets that we are willing to own in the position size that we are willing to own. But given that we're hedge level 2, significant caution should be exercised in establishing new positions until a bottoming pattern forms and you start to get something more significant as an indication that it is an appropriate time to initiate those positions. From sector market postures, remember these lines are relatively flat, so we get a lot of flipping up and down as we have been alternating these days. The only thing I'm going to draw from this is that retail continues to hold up, perhaps the strongest, and that sector may very well be the sector that is the most consistent performer leading out of this range should we break to the top side. If we break down, everything goes down, and you can see that in this, on those big down days, everything is down. Now yesterday was a mixed day, and indeed telecommunications actually had a pretty reasonable day, but you see some of the other sectors that we traditionally look at as doing pretty well. Healthcare down 1.24%, so pretty difficult trading there. In terms of industry groups, you've got retail, internet, healthcare, railroads, and biotech at the top. I suppose we should take a look at some of these that are in the bottom. If we do break down which sectors are likely to be hammered the hardest, well, obviously, a lot of this is the energy complex down here. You also have U.S. banks, gambling, nat gas, and airlines, probably utilities. You see these down here in these lower sectors. Those are likely to be hurt more than the broad market as those that are weakest to begin with. Okay, so as always, greatly appreciate your investment in return with us by liking us on YouTube and sharing about our work with your fellow traders, and greatly appreciate you each and every day. You may send feedback to support@falconglobaltraders.com. Disclaimers as always. Hit the pause button if you need more time to review this. Thank you from Falcon Global, and we look forward to seeing you back here on Monday. Remember, tomorrow's a trade holiday. Thank you.